I think the key to recognize is that's kind of the unlikely scenario. But if we were to get into a cataclysmic collapse in the equity markets, in the Bitcoin and the crypto markets, then that likely would be the bottom. And the reason I came to that conclusion is essentially during the dot-com era, Amazon dropped 95% from its highs before obviously recovering to the record levels that it hit over the last couple of years. So that 95% mapped out to Bitcoin would bring us back to about 3,500. Now, for me, that's not really the likely scenario. I'm at a 12 to 13,000 high-end target with a low-end target of 9,000. But I'd just like to show you here. This is the chart of Bitcoin. And what we can see very clearly here is that we've had a big rally. A lot of people, like if you go on Twitter, they'll say, oh, it's the bottom. We're going to start a new bull market. I disagree. If you look at this M pattern, look at the M pattern. The second portion of the M is higher than the first. Now let's go back to the all-time highs on Bitcoin and look at that pattern. This is a classic topping pattern. So for me, what we've seen recently is actually a bear market rally. We've now come off of that 25,000 retrace with a bear flag. We then dropped, and we're now bear flagging with a likely downside move to at least 18,000 and change. And ultimately, I do think that we're going to see 12 to 13 and eventually 9. And think about this, right? You're in a scenario where if I'm correct that the economy is going to go into recession, then you're looking at the stock market probably with another 25 to 30% down from here on the S&P 500. Now tell me how Bitcoin doesn't go lower if the S&P drops 25 to 30%. We know it's a risk asset, at least right now. That's the likely outcome to the downside, in my opinion.
U.S. authorities transferred $1 billion worth of Bitcoin, BTC, recovered from a dark web hack to new wallet addresses, including one owned by Coinbase on Wednesday, stoking investor fears that intense sell pressures could drive down the token's price. Hello and welcome to Money Talks. In today's video, founder and chief market strategist at InTheMoneyStocks.com and Verified Crypto Investing, Gareth Soloway updates about Bitcoin's current market standing, the final bottom in crypto, and his outlook for Bitcoin in 2023.
We've now seen this sideways chop. And again, look at that. Really, the low here, I mean, you briefly violated it in October, but aside from that, you've been going sideways for a long period of time. Now, when you're a technician like myself, you start to recognize that a pattern like this is what we call a wedge pattern, right? And there's a defined wedge pattern here that unfortunately is more of a bearish wedge, right? You have a down move and then the wedge of consolidation is occurring here. So to me, it's a matter of time until the next leg comes in here. We're seeing the dollar pop today. That could be a headwind if the dollar continues to strengthen, as it's telling us the Fed may continue to raise rates. But bottom line is, investors should be very, very careful. I myself am mostly short at this point in time on the markets, just waiting patiently for that next leg lower. So I'm a trader. I'm at my computer 24/7 almost. I mean, I sleep a little bit, but for the most part, I'm always monitoring during market hours. So I use what I call mental stops. The reason why I'm a little cautious on physical stops is when you deal with significant size, the algorithms can pinpoint where your levels are, and they tend to run your stops. And the term run your stops means basically they say, oh, there's this many players at this price that have a stop. Let's quickly tag them, make them get out of their positions, and then we'll move it in the correct direction. So for me, I'm a big fan of mental, as long as you have the discipline, which a lot of people don't have. But if you have the discipline to go by mental stops, then you want to use mental stops versus physical. Go back to the S&P 500 and take a look here. So what we see here is that you're in this wedge pattern. If we were to break above this wedge pattern, you'd have to assume this is the beginning of a move up. It doesn't mean we're going back to all-time highs, but we're likely going up to this 4320 level on the S&P 500. So really, once you're above this yellow trend line, that would be where you would say, okay, you now have to exercise that mental stop or physical stop and exit the position. But right now, again, notice we're having a nice little down day. We're hammering on this trend line. If this trend line breaks, this is where the next leg lower should kick in. And ultimately, I think I still have it pinned in that we're going down to pre-COVID levels on the S&P 500. That's around 3375 and potentially as low as 33,000 on the S&P.
Authorities moved the Bitcoin in 3 transactions, according to data from blockchain security firm PeckShield. Nearly 10,000 Bitcoin were sent to Coinbase-controlled wallets, while roughly $41,000 tokens were directed to government-controlled wallets. An open market sale would be a departure from authorities' past handlings of seized digital assets. The government usually sells seized assets at auction. In 2014 and 2015, the government auctioned off Bitcoin seized from the owner of virtual black market platform Silk Road.
Partially technical, and it's also psychological, right? So you've been in this bear market for a long period of time. We've seen big names like the GameStops and the AMCs run. We've seen Coinbase have big moves. And so there's this kind of psychological want from investors that they want to see the revisiting of the craziness of 2021. The problem is, the differences are enormous. You don't have the government sending out checks. You don't have interest rates at zero. You don't have massive quantitative easing. And so you're getting these kind of buy the dip mentalities of coming back in, hoping that the bottom is in. The problem is, and by the way, the bottom being in is being driven by a narrative that the Fed is getting close to halting their hikes and actually lowering rates. I disagree with that. I think they are getting close to the end of the rate hike cycle. I just don't think that they're ready to lower rates, especially with some of the inflation data that we've seen recently. So we'll probably see a 25 basis point hike in the next couple of weeks from the Fed when they have their, I think it's March 22nd meeting. But ultimately, the big kicker here is that you're going to see 5% interest rates for a long period of time. The Fed has made it clear they don't want to repeat the issues that Paul Volcker met in the 80s, and that's going to be what's going to really drive the economy into a recession. I think you're in a totally new environment, right? We've been addicted. It's an economy, an investable market that's been addicted to interest rates. In fact, it's so crazy. Like if you talk to economists, if you talk to investors, what do they say? They say, oh, don't worry. If we go into a recession, the Federal Reserve will print money to get us out. Think about that statement. You're basically saying that the economy can't get us out of a recession by itself without the help of printing of money. And that's ludicrous, but that's the situation that we're in right now. So you have to be on the awareness side that at this stage, the Fed is going to be very nervous. They've been bitten by the inflation bug. Remember, they said transitory. It was anything but transitory. And that's going to make it a situation where they're going to be very reluctant to lower rates unless inflation goes below 2%. And I don't have that penciled in for multiple years. So what is that going to mean? It's going to mean we're going to slip into a recession. Essentially, they're not going to lower rates to get us out. They're not going to print money to get us out for a longer period of time. And that puts us in a potential recessionary period for 2 to 3 years at minimum. Consumer is getting more and more stretched. And at some point, you're going to see it reflected across the board in consumer spending. But you're 100% right. Changing your kind of ways of doing things. People are used to spending money, especially post-COVID. They wanted to go out. They wanted to do things. They said, who cares about running up debt? I want to get out. I want to travel. I want to see people. And I think that kind of mentality is very hard to break. And we've seen consumer debt, like you said, skyrocket, credit card debt, skyrocket, even car loans. Look at the defaults starting to hit on car loans. Like there is a tidal wave coming that should hit in the next 3 to 6 months that I do say, I will go on record and say, second half of 2023, we will see the recession hit.
Bitcoin's price may still move as the government reveals its plans for the recently transferred Bitcoin, however. Many things about the government's plans for the tokens remain unknown. It remains unclear if authorities will auction off the Bitcoin. It is also unclear if the government will consolidate the assets at some point.
To me, the recession is going to be a slow rolling recession. It's going to be one like the lobster in the hot water, and I hate to use that kind of imagery, but ultimately where it slowly heats up. And I think initially people are going to say, okay, it's not really going to be that bad. And the Fed probably calms us down by saying, oh, it's not going to be that bad, just like they said it was going to be transitory on inflation. So they have a tendency to understate what's going to ultimately happen, and investors have to be prepared on the other side for something much, much worse. But because it's going to last so long, it's going to continually get worse and worse and worse. But the Fed is unlikely to come to the rescue, at least for the first 12 months of this recession, due to inflation's high levels. So that's going to make it, by the end of this recession, it is going to be nasty. And I think we could be, and I said this before with you as well, I'm looking at no new highs on the S&P 500 for 10 to 15 years. I think that we're in a recessionary period for at minimum 2 to 3 years, and it could even be dragged out longer. Eventually, unemployment goes so high that even if inflation is 3%, the Fed will come to the rescue eventually and stimulate. And again, I'm talking unemployment could be north of 8 to 10%, and then they're going to be forced to stimulate to kind of bring that down. So, and I think there's precedent for that because if you look back at the dot-com collapse, remember that the Fed actually lowered interest rates following the dot-com collapse, and we didn't see technology stocks, the NASDAQ, hitting new highs for really 15 to 16 years. So again, I think the issue too in this scenario is that you're going to see them starting to print or lower interest rates, and then it's going to create a bigger inflation concern, right? So if you don't get inflation back into the box and close that box tight, you're going to have the stimulus creating this fear or reality of higher inflation for longer periods of time. And this is going to be a battle that the Fed is going to wage for years to come against inflation. If you think about it, look at how long we've been in a market with underinflation, with sub 2%. Well, you know what? When you're sub for a period of time, it's likely that you'll be over to even it out for a period of time. And that's going to make it so when you have inflation high, it's going to be very hard for the consumer to really continue to spend at the levels they are able to or they want to before, obviously, the markets get back to all-time highs.
So, what are your thoughts about Gareth Soloway's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.